Welcome to our annual State of the Markets presentation. We are delighted to have you here today and look forward to sharing this important information with you. I'd like to draw your attention to these disclosures. Please take a few moments and review. Let me know if you have any questions. I'm here to help you better understand what happened in the markets in 2023 and what may unfold in 2024. As you can see, we're going to focus on four key questions. How did the stock market perform in 2023? What drove market performance in 2023? Where are we now? What do major financial firms forecast in 2024? So let's begin with a look back at Wall Street analysts like we always do. The initial predictions for the stock market's performance in 2023, how stocks actually performed in 2023, and some of the factors that drove stock market performance. The S&P closed at 4,769 at the end of 2023, a gain of 24%, and well above the most optimistic expectations for Wall Street. In fact, as we can see, forecasts fell well short of how stocks performed. There may have been several reasons for this. The first reason was that many observers and economists expected a recession in the first half of 2023. It never came. They saw higher interest rates and bond yields as suppressing stock returns. Also expected by most experts and investors alike was a swell of AI or artificial intelligence enthusiasm. You imagine the progress, widening interest, and implementation of AI. As AI development unfolded, they sparked a powerful lift in technology companies, which buoyed the rest of the stock market. Stocks also benefited from falling yields as inflation decelerated faster than many had anticipated, leading to hopes of Fed easing. Despite periodic worries over the health of the regional banks and episodic worries that the Fed may remain restrictive for longer than hoped for, stocks moved higher, closing strongly in the final 2 months of 2023. Let's talk about some of the factors that led to this. In the following slides, we'll discuss the factors that affected the stock market of the past year. After a disappointing 2022, stocks moved higher to start the year and continued higher for the remainder of the year outside of a few notable retreats. I want to draw your attention to the plot points on the graph because they highlight the key storylines that drove the stock market in 2023. They come down to two broad themes: the track of inflation and the Fed. As you can see in the early part of the year, the Fed is still hiking rates in the face of still too high inflation. Nevertheless, the market is moving higher, perhaps for two reasons: bargain hunting and anticipating inflation will moderate, and the Fed will eventually stop its rate hikes. As we look at the data points later in the year, sure enough, inflation is coming down, and the Fed is now pausing on further hikes, so much so that by December FOMC meeting, the Fed is signaling rate cuts for 2024. Of course, markets never move in a straight line. There were some hiccups in advance. One was the so-called regional banking crisis in March and some backtracking on inflation progress in September and October. A relatively strong economy and a jump in inflation caused some concern in the fall that the Fed may not have room to ease, which is why we saw bond yields peaking in October. However, as inflation resumed its decline by December, the Fed was comfortable signaling to the markets that rate cuts may be in the offing in 2024. Finally, keep in mind that amid falling inflation, labor markets remained robust and the economy was reasonably healthy, which raised hopes for a soft landing. Corporate earnings are one of the factors that drive stock prices over the long term. As the chart shows, the earnings growth for the S&P 500 companies appears to be emerging from what market watchers call an earnings recession. That is, when there is at least 2 quarters of negative earnings growth. As you can see, corporate profit growth decelerated in the 3 quarters preceding the most recent quarter of reporting, the third quarter of 2023. Overall, companies struggled in recent quarters due to rising prices and global economic growth slowdown. But Q3 was more encouraging as companies recorded positive profit growth for the first time since the third quarter of 2022, aided in large part by a revived consumer spending. While the third quarter was welcomed, it was driven by just a few sectors of the economy. This narrow contribution to earnings growth is concerning and leaves some investors worrying about the durability of earnings growth in the years ahead. We already touched on some of these key economic numbers, but let's spend a little time getting a broader view of the economy in 2023. This year, the word used by Wall Street and economists alike was resilient. They remarked on our resilient economy, our resilient labor market, and our resilient consumer. As this table illustrates, the description is an apt one. With fresh market interest rates hikes throughout the first half of the 2023 on top of unprecedented rate hikes in 2022, many felt that these so-called demand destruction efforts by the Fed to lower inflation would do just that. Reduce consumer and business demand by making purchases and capital investments more expensive. While such rate hikes can take a while to work themselves through the economy and whose lag effects may yet still be felt, the actual experience was that the economy grew at a respectable rate and is slated to expand nicely in the fourth quarter. And the labor market was strong beyond many experts' ability to explain, all the while inflation maintained its downward trend from its height in 2022. The economy in 2023, however, had its issues. Consumer sentiment has remained low and stagnant. Though this seems paradoxical amid healthy economic growth and strong employment, consumers have been especially concerned about the high cost of goods and services. Many experts forget the sharp run-up in prices in 2022 hasn't come down, even if today's inflation rate has. The reality is that despite this inflation, prices today are much higher than they were pre-pandemic, which has soured the mood of many Americans, especially those who are least able to bear the financial burden of higher prices. We also see pessimism in the housing market as reflected in the sentiment index of home builders. High mortgage rates and climbing home prices have left builders and prospective homeowners discouraged about the affordability of buying a new home. So we've looked at some factors affecting the market performance in 2023. Next, let's look at where we are now and examine the headwinds and tailwinds that would affect the direction of our economic growth and financial markets in 2024. To create some context around where the economy stands now, let's examine where we stood in November of 2020. I picked this as a reference point since it represents a moment in time which the nation was finally emerging from the pandemic, though not completely out of it, and Americans went to the polls to vote in national elections. As the indicator suggests, the outlook for the next 3 to 6 months was mixed. The Federal Reserve's monetary policy was still accommodative and interest rates sat at historical lows. Nevertheless, the economy appeared weak, hurt by the consumer sentiment and labor market. I want to draw your attention to inflation in the bottom left-hand corner. It still looked unthreatening at the time. Now let's look at 2022, when many economists and market watchers predicted a recession in 2023. As the indicator suggested, there was a good reason to worry about a recession. As we can see, no economic or financial indicator suggested a strong recovery or stock market. Important measures like consumer spending, corporate profits, and inflation were neutral, while monetary policy, housing, interest rates, and leading economic indexes were all flashing red. Fortunately, the economy and the stock market were a bit more resilient than they imagined. Despite the gloom entering 2023, the economy and the stock market would defy expectations. A reminder that investors should pause before adjusting their long-term investment plans. Now let's take a look at 2024, January. As the indicator suggests, caution may be a good word to describe the economy as we enter the new year. Consumer spending, corporate profits, inflationary pressures, monetary policy, housing, mortgage rates, interest rates, and the leading economic indicators are all neutral. Additionally, the geopolitical risk and international economic categories are all red. It seems that despite the stock market's end-of-year rally, nearly all the financial indicators remain neutral as we enter into this presidential election year. Let's examine one of those speedometers more closely, the leading economic index, LEI. This index includes 10 components ranging from stock prices to manufacturing orders. This data may give you a clearer view of where we are when examined together. As the chart shows, the outlook trended lower throughout 2022 and 2023, though it appears to have bottomed out at the close of 2023. The LEI has been accurate in anticipating the three recessions since the year 2000. However, it appeared to signal a recession for 2023 incorrectly. In fact, GDP growth rose even when LEI was painting a weaker economic picture. So, while no economic indicator is ever 100% accurate, in predicting the economic future, the LEI remains an important input into developing our views about the economy in the coming months. Remembering that past performance is not indicative of future results is key in this data. So here are some potential headwinds from the leading economic indicators and the economic speedometers we just reviewed. It's clear that uncertainty is the watchword for the economy in 2024 economy. The outcomes range is very broad, as economic performance may turn on a few key variables. The first potential headwind facing the markets is inflation. While inflation has gone down from the post-pandemic highs, it has remained persistently above the Fed's 2% target. It may handcuff the Fed a bit if inflation remains stuck in the 3 to 4% range. However, at its final meeting in 2023, the Fed said it anticipates 3 rate cuts in 2024. That leads to our next potential market headwind, which is a recession. The much feared recession did not materialize in 2023, but recessions are natural and inevitable part of the economic cycle. While a case may be made for avoiding a recession this year, there are plenty of reasons that a recession may emerge. Among them are resilience of consumer spending, continued global economic weakness, especially in China, and the surfacing of delayed impact of the steep rise in interest rates over the last few years. Corporate earnings may be a headwind. If stock prices are to move higher, they need to improve from recent levels. We earlier showed how third quarter earnings have hinted at this recovery. The market's current valuation level, quite frankly, may have already priced in the recovery. And should the expected growth in the earnings fail to materialize, it will be difficult for stocks to rise from these current levels. So geopolitical tensions are always a wild card. For example, first it was anticipated invasion of Ukraine in 2022, and then there was a conflict in Israel in 2023. Looking ahead, we see still a stalemate in Ukraine, ebbing Western support, and uncertainty as to what follows in the Gaza Strip. And of course, China's muscle flex in the Pacific region remains worrying. Finally, the stock market now has competition for investment dollars. With bond yields at levels not seen in decades, many investors may find that they can obtain a reasonable return at less risk, leading to fewer dollars to support higher stock and equity prices. So let's talk about some potential tailwinds here. While the headwinds facing stocks are uncertain, there are not to be underestimated. There are several potential tailwinds that may support the financial markets in 2024. One reason for the rally in the fourth quarter of 2023 was continued deceleration in inflation. If inflation maintains its downward trend, it will be a positive for stocks since it may help increase corporate profits and allow the Fed to move ahead with rate cuts in 2024. The caveat here is that the Fed has said it will need to commit it to inflation fight. Another potential tailwind is the prospect of China returning to the strong economic growth, which could have a broad benefit for the global economy. China's economy has been struggling under the weight of the late lifting of COVID-related restrictions, among other factors. Nevertheless, they remain a dynamic economy that may only be a government intervention away from recovery. Finally, there's a start of a new economic revolution akin to electricity and computers. Of course, I'm referring to artificial intelligence, or AI. The emergence of AI was a big story in 2023 and a major catalyst for the market. Most of the excitement was based on the future potential. This year, we may begin seeing the initial real-world impact to businesses as AI potentially turns into a new and substantial revenue stream for the AI ecosystem of providers, from chip makers and software companies to cloud providers through which AI models operate. Perhaps more importantly, we may also see non-technology companies behind wider implementation of AI in marketing, sales, operations, and administrative functions to drive growth, productivity, and higher profits. Before discussing the 2024 forecast, let's examine this chart to see where stock prices trend against historical averages. The most common way to do this is what we call PE in the industry, or price to earnings, which measures investors' willingness to pay for companies' earnings. Look at the dotted line in the middle. You can see that the PE for the past 25 years is about 16 times. You can also see that the PE moves quite a bit, with a peak in 1999 and a trough in 2008. The chart also shows that the PE was about 17.8 times in September of 2023. Does that mean that stock prices will head higher or lower in the months ahead? We don't know, but like we said, past performance is not indicative of future results. It's very difficult to use what we call technical analysis to make prognostications about stocks. We talked about what impacted markets over 2023 and what may impact markets in 2024. Now let's see what professionals have to say about where they think the market's going to be going, and discuss some of the potential headwinds and tailwinds we just finished reviewing. Before discussing Wall Street analyst predictions, let's examine some important inputs that may impact the stock market's direction in the coming year. As you may know, corporate earnings may be a key driver of stock market performance in 2024. According to FactSet, a leading financial data and analytics firm, earnings are expected to trend higher in 2024, plateauing by a fourth quarter. While that is a good sign, it is also difficult to say how much of that earnings growth expectation has already been priced into stocks, especially in light of their current valuation level. Estimating quarterly earnings is difficult, but such estimates can help guide decisions about what price to pay for a stock. If earnings are healthy, it may support higher prices. Conversely, should earnings come in short of expectations, it may put downward pressure on the stock prices. It's important to remember that forecasts or forward-looking statements are based on assumptions subject to revisions without notice and may not materialize. As we've learned about anything during the past couple of years, the outlook for financial markets can change quickly. The course of stock prices in 2024 may be correlated to the Fed's decisions about interest rate. One tool traders look to understand where rates may be heading is the CME FedWatch tool, which analyzes the probabilities of future target rates as implied by the 30-day Fed funds futures pricing. I know that's a mouthful, but if we look at where the market thinks the Fed is going, we see that the market believes there is almost a 42% probability that the federal funds rate falling by 50 basis points, or half a percentage point by the June end. In early December 23, the Fed funds rate was 5.25% to 5.5%. Traders are also priced as nearly as a 20% probability for a 75 basis point decrease within the first 6 months of 2024. Well, there was a 30% likelihood of just a quarter of 1% cut. There's only a 7% chance that rates will remain unchanged by mid-year. The market's optimism has often raced ahead of the Fed's intention, so investors should be cautious. However, if these cuts come to fruition, it may be positive implication for stocks. Keep in mind the CME's group table changes daily. Probabilities are based on assumptions and are subject to revisions. Financial, economic, political, regulatory issues may cause the actual results to differ from the expectations expressed at the table. The data from this tool does not constitute investment advice and is not personal recommendation from the CME group. Economic forecasters surveyed by the Philadelphia Fed in the fourth quarter updated their outlook for Q4 2023 and all of 2024. They slightly increased their expectations for Q4 GDP growth to 1.3% from 1.2%. In 2024, they anticipate positive growth each quarter. So at this point, no recession appears in the forecast. Interestingly, their unemployment rate projections stay flat throughout the first half of the 2024, with a slight uptick toward year end. It will be interesting to see how or if economic growth influences the unemployment rate. I've said this before, but it's important to remember that forecasts are based on assumptions and subject to revisions over time. Financial, economic, and political and regulatory issues may cause the result to differ from expectations expressed in this forecast. Aside from interest rates and inflation, one of the most critical factors that may decide how the economy and the stock market do in the new year is the health of the consumer. Consumer spending represents about 2/3 of the American economy, and if consumers pull in their spending in 2024, it could have consequences for the markets. Consumer spending trending higher following the pandemic, first on goods as Americans spent time sheltered in their homes buying stuff, and then on services like travel once COVID restrictions were lifted and they felt comfortable leaving their homes. This bulge in spending was lifted by what economists call excess savings, i.e., the amount of savings over the level that would have likely been reached without the pandemic. The primary sources of these excess savings were not spending on things like commuting to work, clothes, and dining out, and government transfer payments, e.g., stimulus checks. As we see from the chart on the left, the amount of excess savings has declined with time, leading some economists to wonder if the consumer can maintain their pace of spending. Now, if we look at the chart on the right-hand side, we see consumer debt levels from auto loans to credit card loans. Credit card balances often get the most attention in the financial news, but all five categories are important to watch. Will the combination of shrinking savings and changes in household debt influence consumer spending habits? That's difficult to answer, but consumers can surprise the experts. One key positive is that Americans are broadly employed, and for now, they can find work if they need to. So, what are some of the major financial firms forecasting for domestic prices in 2024? As they did for 2023, analysts are painting a mixed year for stocks, as the average forecast sits about where the stocks ended in 2023. You'll notice a significant divergence in these forecasts, running from as low as 4,200 in the S&P to 5,100. The range of sentiment from bearish to modest optimism may be largely attributed to many of the issues we discussed in the presentation. Will the Fed cut rates or keep them higher for longer? Will there be a recession? Will it be that hope for a soft landing? Will the economic landing be harder? Will corporate profits grow in the current valuations? Will inflation continue to decline? Many of these are binary events. For instance, the Fed will cut rates or it won't. This set of binary possibilities has resulted in much uncertainty as we head into 2024. And that uncertainty is shared by market experts from the most prominent firms. Of course, no one knows what equities will do in 2024, and predictions at this stage are just that, predictions. Like other images in this presentation, this image includes a forecast. So it's important to remember that forecasts are based on assumptions and subject to revisions over time. We've covered a lot of information, focusing most of our discussion on what drove the market and what we expect to move the market over a short time. I want to end our investment discussion with a word on the importance of investment discipline. We're sticking with your investment strategy. The potential of stocks to help build wealth over long term may be challenging when investors move in and out of financial markets. If we look at this image, we see a direct correlation to the probability of having positive gains in stocks with the time such investments are held. So, for instance, over the 94 years, 73% of all one-year periods have positive returns. However, if we travel out to longer holding periods, we see that likelihood of investment success rises to 84% for 3-year periods, 88% for 5-year periods, 94% for 10-year holding periods. In this illustration, stocks are represented by the S&P 500 Composite Index, which is an unmanaged index, and it represents the overall U.S. stock markets. What can you do in 2024 to move closer to your goals? Here are some action items. If your life or personal situation changes, keep us in the loop. We want to hear more about important family events like births and deaths. We also care about health issues, employment changes, and any financial developments that may change your situation. If you find yourself thinking about new goals or reevaluating your priorities, share your thoughts with us so we can help you pursue the life you most desire. On top of specific adjustments in your financial life, we also want to know you and how you feel about investment changes. These could be details like risk tolerance shifts or market environment concerns. Finally, review your estate documents, beneficiary designations, and other paperwork to ensure they're all up to date. A well-organized estate is one of the best gifts you can give to your family. We're here to discuss any financial situations and questions or worries you may have, Our priority is always to help you make informed choices and stay on track. Throughout 2024, we will focus on delivering the following. We'll keep you informed through regular communication. We'll manage your investment according to your personalized strategy, and we'll remain abreast of economic factors and adjust accordingly. So until next time, thank you so much for your time today. As you can tell, I'm passionate about helping you understand the markets. For more information and timely updates, please follow us on social media and contact us anytime. We hope that you enjoyed the details we shared today.